There's a quiet poison that infects the world of finance. An unspoken lie taught in every business school and practiced in every cubicle on Wall Street. It's the idea that a business, in all its chaotic, human, and unpredictable glory, can be perfectly understood by reducing it to a series of numbers on a spreadsheet. Price to earnings, debt to equity, discounted cash flow. We're told these are the sacred tools of analysis, the keys to unlocking wealth and beating the market. But this is a dangerous illusion. A graduate with a finance degree, a master of Excel, believes they have a map of the world, when in reality, they have a coloring book. They can see the lines, but they are utterly blind to the vibrant, three-dimensional reality that gives those lines meaning. They are the man with a hammer, and to them, every complex investment problem looks like a nail. This spreadsheet myopia, this addiction to the quantifiable, is the single greatest reason why 99% of investors fail to achieve extraordinary results. They analyze the numbers, but they don't understand the business. They track the stock price, but they miss the tectonic shifts in technology, culture, and human behavior that truly dictate a company's fate. They are playing checkers on a chessboard. The world's greatest investors, figures like Warren Buffett and his partner Charlie Munger, operate on a completely different plane. Their real advantage, the source of their multi-billion-dollar fortunes, doesn't come from a more sophisticated spreadsheet. It comes from a secret thinking tool, a mental operating system that allows them to see the world not as a collection of numbers, but as a dynamic interplay of powerful, invisible forces. They call this tool a latticework of mental models. It's the practice of borrowing the biggest, most important ideas from every major discipline: psychology, physics, biology, history, engineering, and using them as a collection of lenses to view any given problem. Because the world is not a finance problem, the world is a psychology problem, an engineering problem, a history problem, all wrapped into one. By building this lattice work, they transform their minds from a simple toolbox containing only a hammer into a comprehensive workshop, filled with every conceivable tool for understanding reality. This is the path out of the flat, colorless world of the spreadsheet and into the rich, complex, and profitable world as it truly is. This is not about learning a new formula. It's about upgrading the very way you think. It's about developing a CEO mindset, even if you're just starting your journey in personal finance. The financial transformation that follows is profound. You stop being a passive analyst and become an effective thinker, capable of identifying opportunities and risks that are completely invisible to the narrow-minded specialist. You begin to see the whole board. And that, in the world of investment strategy and wealth management, is the only advantage that truly matters. The journey to building this powerful mental toolkit begins with a diagnosis of the disease it is meant to cure. To understand the cure, you must first truly appreciate the sickness. Charlie Munger, the intellectual architect of Berkshire Hathaway, diagnosed it perfectly. The sickness is the curse of the expert, the professional who becomes so skilled in their own narrow domain that they become blind to reality itself. Imagine a young Charlie Munger, not yet the Oracle of Omaha, but a successful lawyer and budding investor, attending a lecture at a prestigious university. He's sitting in a hall, filled with the best and brightest minds, listening to a professor from the economics department. The professor presents elegant equations, flawless models that describe human economic behavior with mathematical precision. But Munger feels a deep sense of unease. He looks at the beautiful, sterile formulas on the board and compares them to the messy, irrational, and glorious chaos of the real world he sees every day in business. He sees people driven by envy, by fear, by love, by the desperate need to look good in front of their neighbors, forces that simply do not exist in the professor's equations. The professor is a man with a hammer, the hammer of neoclassical economics, and every human problem is being pounded into the shape of a rational, utility-maximizing nail. After the lecture, Munger might have walked across the campus and sat in on a psychology lecture. Here, a different professor talks about cognitive biases, about the deep, instinctual, and often illogical programming of the human brain. He hears about social proof, how people will follow the herd even when the herd is stampeding off a cliff. He learns about the power of incentives, how a simple reward system can make good people do terrible things. Suddenly, the world of business and markets makes more sense. The psychology professor has a different set of tools, and with them, he can explain the booms and busts, the manias and panics that the economist's perfect models could never account for. Munger's great insight, the foundational idea of his entire philosophy, was born from this frustration. He realized that to silo knowledge into rigid academic departments was an act of intellectual suicide. The world is not organized by university departments. A business problem is never just a finance problem. It is a problem of human psychology, of competitive dynamics which mirror biological ecosystems, of system integrity, which is an engineering concept, and of historical precedent. To try and understand it with only one set of tools from one department is like trying to assemble a car with only a screwdriver. You will fail, and you won't even understand why. This led Munger to his famous articulation of the problem. To a man with only a hammer, every problem looks like a nail. This is more than a clever aphorism. It's a deep, psychological truth. The human brain craves simplicity and efficiency. When we develop expertise in one area, our brain creates cognitive shortcuts. We start to see the world through the filter of our expertise. The accountant sees the world as a series of debits and credits. The lawyer sees it as a web of potential liabilities. The marketing expert sees everything as a branding opportunity. This isn't a character flaw. It's a feature of our mental hardware, a cognitive bias known as the law of the instrument or Maslow's hammer. It's the brain's way of managing complexity. But in the world of investing, where complexity is the name of the game, this feature becomes a catastrophic bug. A financial analyst, trained for years to dissect income statements and balance sheets, will naturally gravitate towards what they know. Their hammer is the discounted cash flow model. They project future earnings, apply a discount rate, and arrive at a precise number for a company's intrinsic value. It feels scientific, it feels certain, but it is an illusion of precision. The real drivers of a company's long-term success or failure, the strength of its brand, the quality of its management, the culture of its workforce, the threat of a disruptive new technology, these things have no neat little cells on the spreadsheet. And so, the man with the hammer simply ignores them. He pounds the square peg of reality into the round hole of his model, and he feels brilliant for doing it. This isn't just a theoretical problem. It has a name, and its name is long-term capital management. In the mid-1990s, LTCM was the smartest room on Wall Street. It was founded by John Meriwether, a legendary bond trader from Salomon Brothers, and its partners included two Nobel Prize-winning economists, Robert Merton and Myron Scholes. Their hammer was not just any hammer, it was a godlike hammer forged in the fires of financial academia. They built breathtakingly complex quantitative models to exploit tiny pricing inefficiencies in the global bond market. Their spreadsheets were masterpieces of mathematical genius. They believed they had created a scientific, foolproof money-making machine. For a few years it worked spectacularly. They generated returns of over 40% a year. They managed over $100 billion in assets with an almost religious faith in their models. But their models, for all their genius, had a fatal flaw. They were built entirely within the world of finance. They accounted for market volatility, interest rate spreads, and credit risk with mind-boggling sophistication. But they had no input for human panic. They had no variable for geopolitical contagion. They had no cell on their spreadsheet for the complete, gut-wrenching, irrational fear that can seize the entire global financial system. In 1998, Russia defaulted on its debt. It was a shockwave. A tremor of fear, not logic, ripped through the markets. Investors fled from anything that seemed risky, a classic herd mentality stampede. The tiny pricing inefficiencies that LTCM was built to exploit suddenly widened into vast, gaping chasms. Their models told them this was a statistical impossibility, a 10 sigma event that shouldn't happen in the entire lifespan of the universe. But it was happening. Their hammer was useless. The problem was no longer a nail, it was a tidal wave. They were leveraged over 100 to 1. Every tick against them was magnified 100-fold. The smartest men in the room were wiped out, losing over $4.6 billion in a matter of weeks and bringing the entire global financial system to the brink of collapse. They were the ultimate men with a hammer, and their failure serves as a permanent, terrifying monument to the danger of spreadsheet myopia. The way to avoid this fate, the blueprint for a more robust form of critical thinking, is what Munger called a, quote, two-track analysis. It's a mental model for decision-making that forces you out of your narrow comfort zone. The first track is the rational, quantitative analysis. You must do the work. You build the spreadsheet, you calculate the ratios, you project the cash flows. This is the world of the finance professional. You have to speak the language, but you cannot stop there. That is only half the job. The second track is where the real work of a master investor begins. Here, you put away the calculator, and you pull out a checklist of the great, non-numeric models from the wider world. You run the problem through a filter of psychology. What are the incentives at play here? Is the management honest and able? Is the customer base driven by logic or by emotion? Is the company benefiting from or being victimized by herd behavior? Then you run it through a filter of engineering. What is the margin of safety? How much stress can this system take before it breaks? Is there redundancy built in? Or is it a fragile, tightly coupled system like LTCM, where one failure will cascade into total collapse? You run it through a filter of biology. What is the competitive ecosystem? Is this company a dominant apex predator in a stable niche, or is it a vulnerable herbivore in a landscape filled with powerful carnivores? How is it adapting to changes in its environment? This two-track analysis is not easy. It's a discipline of lifelong learning. It requires humility, the admission that your own specialty is not enough. The direct financial connection of this approach is the difference between genius and catastrophe. An analyst looking at a company like Coca-Cola in the 1980s, using only a spreadsheet, might have concluded it was fairly valued, or even overvalued. It was a mature company with modest growth prospects. The numbers were fine. But an investor using a two-track analysis, like Warren Buffett, saw something entirely different. Yes, he did the math, but then he engaged the second track. He analyzed the psychology, the brand's association with happiness, a share of mind that created immense pricing power. He analyzed the engineering of its distribution system, a global network of bottlers that was a logistical marvel, nearly impossible to replicate. He analyzed its ecosystem, a dominant species with a nearly unassailable moat. The numbers on the spreadsheet told one story. The latticework of mental models told a much deeper, more profitable one. Buffett's subsequent investment of over $1 billion turned into one of the greatest trades in history. Conversely, the analyst who fell in love with Enron in 2000 saw a masterpiece of a spreadsheet. The numbers were incredible, earnings were growing to the sky. They had a story about a new economy for energy trading. The man with the hammer saw a perfectly crafted nail, but a two-track analysis would have screamed danger. The psychology, hubris, arrogance, and a clear misalignment of incentives driving executives to hit quarterly numbers at any cost. The engineering, a financial structure of special-purpose entities that was absurdly complex, opaque, and brittle. It was a house of cards. The spreadsheet analysts cheered it all the way to zero. The multi-model thinkers like Buffett and Munger stayed a million miles away. This is the choice every investor faces. You can live in the flat, black and white world of the spreadsheet, a world of false precision and hidden risks, or you can begin the work of building a latticework of mental models, a rich, full-color, three-dimensional view of reality that allows you to achieve true, sustainable portfolio growth. The first and most critical set of tools you must add to your mental workshop comes from the discipline of psychology. If a business is anything, it is a collection of people. People who make decisions, people who buy products, people who compete, people who cooperate. To try and understand a business without understanding the fundamental operating system of the human brain is an act of profound ignorance. It's like being a biologist who doesn't believe in DNA. Charlie Munger has said that if you want to be a great investor, the first $100,000 you spend on your education should be on learning the big ideas from psychology. Forget the MBA, he implies. Master the mind. The foundational anecdote that perfectly illustrates this principle is the story of Berkshire Hathaway's acquisition of See's Candies in 1972. On the surface, it was a simple transaction. A family-owned chocolate company in California was for sale. Warren Buffett and Charlie Munger took a look. The numbers were decent, but not spectacular. The asking price was $30 million, while the company had only about $8 million in tangible assets, like factories and inventory. The other $22 million was for goodwill, that fuzzy, intangible concept that spreadsheet jockeys hate. Buffett, at this point in his career, was still a disciple of his mentor, Ben Graham. He was a cigar-butt investor, trained to look for discarded companies, trading for less than the value of their assets. He was looking for ugly, unloved businesses on the cheap. By this strict quantitative measure, See's Candies was expensive. The numbers didn't quite sing. Buffett's first instinct was to pass. But Charlie Munger, the man obsessed with psychology, saw something that wasn't on the balance sheet. He pushed Buffett to look deeper. Munger understood that See's wasn't just selling chocolate. They were selling happiness, nostalgia, and social convention. He saw the powerful psychological forces at play. For decades, customers in California had been buying See's Candies as gifts for Christmas, for Valentine's Day, for birthdays. The act of giving a box of See's was deeply ingrained in the culture. A young man, taking a box of chocolates to his new girlfriend's parents for the first time, would not risk buying a cheaper unknown brand. He would buy See's because it signaled quality and good taste. He was paying a little extra to avoid the social embarrassment of being seen as cheap. This gave See's an incredible psychological moat, pricing power. Because the product was associated with special occasions and powerful emotions, customers were not particularly sensitive to small price increases. A box of candy is a small part of a big emotional event. If the price went up by 10%, from $10 to $11, nobody cared. That $1 was insignificant compared to the emotional value of the gift. Munger and Buffett realized they were buying a business that could raise its prices year after year without losing customers and without needing to invest much additional capital. This was a money machine powered not by tangible assets but by human psychology. They paid the $30 million. It was a turning point for Berkshire Hathaway. See's Candies went on to generate over $2 billion in pre-tax profit for them over the subsequent decades, on an initial investment that required very little additional capital. It was the investment that taught Buffett the difference between a good company and a great business, and that greatness often resided in the intangible psychological connection a company has with its customers. The See's Candies story is a masterclass in the power of understanding investor psychology and consumer behavior. At its core, Munger was analyzing cognitive biases. One key bias at play is what psychologists call loss aversion. Research by Daniel Kahneman and Amos Tversky showed that humans feel the pain of a loss about twice as strongly as they feel the pleasure of an equivalent gain. That young man buying chocolate for his girlfriend's parents wasn't thinking about the pleasure of saving $1. He was thinking about the intense pain and embarrassment of being judged as cheap. He was willing to pay a premium to avoid that potential loss. Another powerful force is social proof, or herd mentality. When everyone around you considers See's to be the gold standard for gift chocolates, it becomes the default, socially validated choice. Going against the grain requires cognitive effort and carries social risk. It's simply easier and safer to do what everyone else is doing. This creates a self-reinforcing loop. The more popular See's becomes, the more powerful the social proof, and the harder it is for a competitor to break in. This is a fortress built of mind stuff, stronger than any factory wall. But perhaps the most important psychological principle Munger champions is the power of incentives. He famously said, "Show me the incentive, and I will show you the outcome." He believes that human beings are driven above all else by the reward systems they are placed in. To understand a business, you must ignore the mission statements and the marketing slogans and focus with laser-like intensity on how people get paid. This leads to a powerful blueprint for any investor or entrepreneur, the incentives audit. It is a step-by-step process for dissecting the true motivations within a company. Step 1. Identify the key players. This isn't just the CEO, it's the head of sales, the chief technology officer, the factory floor manager, the customer service representative. Who has the power to create or destroy value? Step 2. Map their compensation. Get the company's proxy statement and read the compensation section. For the CEO, is their bonus tied to short-term earnings per share or to long-term return on invested capital? An obsession with quarterly earnings can lead to disastrous short-term thinking, like cutting research and development to make the numbers look good. Is their compensation mostly in stock options? If so, are those options priced at the current market price or lower? Do they encourage risky bet-the-farm behavior to get the stock price up, or do they reward steady, sustainable growth? Step 3. Look beyond the executive suite. How is the sales force compensated? Are they paid a commission based purely on the volume of sales, or is it tied to the profitability of those sales and customer satisfaction? A volume-based system will incentivize them to sell to anyone, even unprofitable customers, and to make promises the company can't keep. Step 4. Ask the killer question. If I wanted to game this system, how would I do it? Try to think like a cynical, self-interested employee. What behaviors does the incentive structure really encourage, regardless of what the official company policy says? If you find that the incentives are perfectly aligned with the long-term interests of the shareholders and customers, you have found a rare and beautiful thing. If you find that they encourage short-term, selfish, or value-destroying behavior, run for the hills. The antithesis of this way of thinking, the path of the 99%, was laid bare for all to see in the lead-up to the 2008 financial crisis. It was a catastrophe caused almost entirely by perverse incentives. The entire subprime mortgage industry was a textbook example of a flawed incentive structure. The mortgage broker, the person on the front lines, had one incentive: close the loan. They got paid a commission for volume, not for the quality or long-term performance of the loan. So they had every incentive to push a loan onto a borrower who couldn't afford it, to fudge the paperwork, to ignore the warning signs. Once the loan was made, it was bundled with thousands of other loans and sold to an investment bank. The banker's incentive was to slice and dice these bundles into complex securities, get a friendly rating agency to slap a AAA rating on them, and sell them to unsuspecting investors like pension funds. The banker got a huge bonus and moved on. The rating agency, which was supposed to be the impartial referee, was paid by the investment bank that was issuing the security. Their incentive was to keep their client happy by giving them the ratings they wanted, not to provide an accurate assessment of the risk. At every single step of the chain, the incentives were geared towards short-term, reckless behavior. Everyone was getting paid to pass the risk down the line. It was a system that was mathematically, psychologically, and morally guaranteed to explode. Investors who only looked at the surface-level numbers, who trusted the authority of the AAA ratings, were wiped out. Investors who conducted an incentives audit, who asked, "How do these people get paid?" would have seen the disaster coming from a mile away. The direct financial connection of applying psychology to your investment strategy is immense. It allows you to properly value one of the most important but least understood items on a balance sheet: goodwill. Goodwill is the premium a company pays when it acquires another business, over and above the value of its physical assets. For the spreadsheet analyst, it's a meaningless plug number. For the psychological thinker, it is the quantifiable value of a brand, a reputation, and customer loyalty. See's Candies is the perfect example. The reason it could produce so much cash over the years is that its psychological moat gave it pricing power. This pricing power translates directly into a higher return on tangible capital. Imagine two companies. Company A is a commodity business, like a steel mill. It has $1 billion in physical assets, furnaces, factories, equipment. Due to intense competition, it can only earn a 5% return on that capital, or $50 million a year. Company B is See's Candies. It has only $8 million in tangible assets, but because of its psychological moat, it can earn $50 million a year. Company A has a return on tangible capital of 5%. Company B has a return on tangible capital of over 600%. That is the financial power of a psychological advantage. By learning to see businesses not as spreadsheets, but as human systems driven by biases and incentives, you move from a one-dimensional to a multidimensional analyst. You develop the CEO mindset required for effective decision-making. This isn't just a tool for stock analysis. It's a fundamental upgrade to your critical thinking that will pay dividends in every area of your life. It is the first, essential step in building a true latticework of mental models. Once you begin to see the world through the lens of psychology, you must next add the hard-edged, reality-based models from engineering and physics. While psychology helps you understand the irrational human software running the business, engineering and physics help you understand the structural integrity of the business itself. Is it a robust, resilient structure built to withstand storms, or is it a fragile house of cards waiting for a gust of wind? These models provide a powerful antidote to the optimistic narratives and wishful thinking that so often dominate business discussions. They ground your analysis in the unforgiving laws of physical systems. The quintessential story of this thinking in action is Warren Buffett's decision to buy the Burlington Northern Santa Fe Railroad, now BNSF, in 2009. To the typical Wall Street analyst, a railroad was an old-world, boring, capital-intensive business. It was the opposite of the sexy, fast-growing tech companies they loved. Their spreadsheets showed high fixed costs, powerful unions, and cyclical demand. The hammer-wielding analyst saw a rusty nail. But Buffett, applying models from outside of finance, saw a masterpiece of engineering and a fortress of physics. He didn't just see a company. He saw a system. A railroad is an immense, interconnected physical network. The tracks, bridges, tunnels, and switching yards are not just assets on a balance sheet. They are a system that is nearly impossible to replicate. Think about the engineering challenge. You cannot decide one day to build a competing rail line from Los Angeles to Chicago. The land acquisition, the regulatory approvals, the sheer capital cost, it creates an enormous barrier to entry, an engineering moat. Buffett understood that BNSF and its main competitor, Union Pacific, had a duopoly on moving goods across the western United States. They were the essential arteries of the American economy. Another model he used, borrowed from physics, is the concept of efficiency and scale. Moving a ton of goods by rail is 4 times more fuel efficient than moving it by truck. This is a fundamental law of physics. Rolling friction is far lower than rubber tire friction. As the cost of fuel inevitably rises over the long term, this physical advantage becomes a massive, durable economic advantage. He wasn't just betting on a company. He was betting on a more efficient mode of transportation, a bet on the laws of physics. Furthermore, he understood the concept of operational leverage, another idea with roots in physics. A railroad has immense fixed costs. The tracks and trains are there whether they are carrying 1 container or 1,000. But once those fixed costs are covered, each additional container adds almost pure profit to the bottom line. It's like a lever. A small increase in force on one end, volume, produces a huge increase in force on the other end, profit. He saw that as the U.S. economy grew, the volume of goods needing to be moved would grow with it, and BNSF, as an essential, efficient artery, would capture a disproportionate share of that growth, translating it into massive profits. He was buying an irreplaceable piece of American infrastructure, a system with durable competitive advantages rooted in the physical reality of the world. The underlying cognitive error that this type of thinking corrects is our brain's preference for simple, linear stories over complex systems thinking. Our minds evolved to understand immediate cause and effect. A lion appears, we run. We throw a rock, the animal falls. We are not naturally equipped to understand the intricate, interconnected, and often delayed effects within a complex system like an economy or a large corporation. We see a company's sales go up, and we assume profits will go up in a straight line. We fail to see the feedback loops, the tipping points, and the nonlinear relationships that govern the real world. Systems thinking, a discipline with roots in engineering and biology, is the cure. It trains you to see the whole, not just the parts, to see the connections, not just the objects, to see the patterns of change, not just the static snapshots. This leads to one of the most important mental models in all of investing, a direct import from engineering, margin of safety. The concept was first articulated by Buffett's mentor, Benjamin Graham, but its intellectual roots lie in the way an engineer designs a bridge. When an engineer designs a bridge to hold 10,000 pounds, they don't build it to fail at 10,001 pounds. They build it to hold 30,000 or 40,000 pounds. That massive cushion is the margin of safety. It accounts for unforeseen stresses, for material fatigue, for calculation errors, for the wild uncertainties of the real world. An investor must do the same. The blueprint for applying the margin of safety model is a three-step process. Step 1. Calculate the intrinsic value of a business. This is your best, most conservative estimate of what the business is truly worth, based on its future cash-generating power. This is the bridge's stated capacity of 10,000 pounds. This step requires diligent financial analysis. It is the first track of the two-track mind. Step 2. Look at the current market price. This is the price the stock is trading for today on the stock market. This is the actual load being placed on the bridge right now. Step 3. Insist on a significant discount. You only buy when the market price is substantially below your calculated intrinsic value. You want to buy a $10 business for $5 or $6. That discount is your margin of safety. It's your protection against being wrong, against bad luck, against the inevitable storms that will rock the market. If you calculate a company is worth $100 per share, you don't buy it at $98. You wait until fear or pessimism in the market drives the price down to $60. That $40 discount is your margin of safety. It means that even if your initial calculation was a bit too optimistic, even if the company hits a rough patch, you have a huge buffer that protects your principal and gives you a much higher probability of a satisfactory return. The path of the 99%, the antithesis of this robust engineering-based thinking, is perfectly embodied by the spectacular collapse of Enron. On paper, Enron was a miracle of financial engineering. They created complex new markets for trading everything from energy to weather futures. Their financial statements, crafted by their CFO Andy Fastow, were models of apparent sophistication. They were the darlings of Wall Street, praised for their innovation and complexity. But their complexity was not the robust complexity of a well-designed system. It was the brittle, opaque complexity of a fraud. They lacked any concept of redundancy or margin of safety. They used off-balance sheet entities called special-purpose entities to hide debt and inflate earnings. These entities were all interconnected in a fragile, tightly coupled web. When one piece started to fail, it triggered a cascade of failures throughout the entire system. An engineering mindset would have seen this immediately. An engineer knows that any system without redundancy, backup systems, fail-safes, margins of safety, is a system destined for catastrophic failure. Enron was a financial skyscraper built without a foundation, without fire escapes, and with materials that were designed to look strong on paper but were actually hollow. The spreadsheet analysts, mesmerized by the reported earnings growth, saw only the beautiful facade. The systems thinkers saw the fatal structural flaws. When the first tremor hit, a revelation about their accounting practices, the entire edifice didn't just crack. It disintegrated into dust. The financial connection of these models is profound and direct. It manifests in how you analyze a company's balance sheet and its overall business model. A company with a strong balance sheet, lots of cash, little debt, has financial redundancy. It has a shock absorber. When a recession hits, it can survive, and even thrive by buying up weaker competitors. A company with huge amounts of debt has no margin of safety. It is a fragile system, vulnerable to the slightest disruption in its cash flow. This is a direct parallel to an over-leveraged bridge. Similarly, understanding operational leverage, the physics model, allows you to see why some businesses are far more profitable than others as they grow. A software company, for instance, has massive operational leverage. The cost of writing the code is a huge fixed cost, but once it's written, the cost of selling one more copy is virtually zero. Every additional sale flows almost directly to the bottom line. This is a powerful economic lever. A consulting firm, by contrast, has low operational leverage. To double its revenue, it has to roughly double its staff of consultants. Its costs grow in a linear fashion with its revenue. Understanding the engineering and physics of a business model, its leverage points, its fragilities, its built-in redundancies, and its margin of safety is essential for any form of serious business analysis or wealth management. It forces you to respect reality and to build a portfolio that is not just designed for the calm weather of a bull market, but is engineered to withstand the inevitable hurricanes of the financial world. It is the second great pillar in your latticework of mental models. Having grounded your analysis in the realities of human psychology and the robust principles of engineering, the next layer of sophistication comes from the world of biology and ecology. A business does not operate in a vacuum. It exists within a complex, dynamic, and often brutal competitive environment. The models of evolutionary biology, of adaptation, extinction, and ecological niches provide a framework for understanding competition and corporate longevity that is far more powerful than any static analysis of market share. To think like a biologist is to see the economy not as a machine, but as an ecosystem. The story of Warren Buffett's multi-decade investment in the Coca-Cola Company is the perfect illustration of this biological mindset. When Buffett first invested heavily in Coke in 1988, many analysts saw a mature, slow-growing company. They looked at the numbers. But Buffett looked at the ecosystem. He saw Coca-Cola not as a mere beverage company, but as a dominant species, the apex predator of the non-alcoholic beverage world. What was the source of its dominance? He analyzed its genetic code, the brand. The Coca-Cola brand was a powerful idea, replicated in the minds of billions of people across the globe, passed down from generation to generation through the powerful medium of advertising. This mental association with happiness, refreshment, and American culture was a piece of intellectual DNA that was incredibly difficult to compete with. Then he looked at its physiology, its distribution system. Coke had built a global network of bottlers and distributors that was an organizational miracle. It meant that you could travel to the most remote corners of the planet and you would be able to find a cold bottle of Coke. This network was like a vast root system, drawing resources and delivering the final product everywhere. A new competitor couldn't just invent a better-tasting drink. They would have to replicate this impossibly complex and expensive global distribution system. This combination of a powerful brand, its genetic code, and an untouchable distribution system, its physiology, gave Coca-Cola a secure, ecological niche. It had what Buffett would famously call a moat, a durable competitive advantage that protected it from competitors, just as a moat protects a castle from invaders. He saw that this moat was so wide that the company could consistently raise prices, expand into new markets, and fend off attacks from rivals like Pepsi. He wasn't just buying a snapshot of earnings, he was buying a business with a powerful, self-reinforcing evolutionary advantage that would allow it to thrive and dominate for decades to come. He was thinking like a biologist. This approach stands in stark contrast to the common cognitive bias explained by the Red Queen effect, a concept from evolutionary biology named after a character in Lewis Carroll's Through the Looking Glass. The Red Queen tells Alice, "Here, you see, it takes all the running you can do to keep in the same place." In biology, this refers to the co-evolutionary arms race between species. A predator evolves to run faster, so the prey must also evolve to run faster, just to maintain the same survival rate. The same is true in business. In many industries, particularly technology, companies have to invest billions in research and development, constantly innovating, just to keep up with their competitors. They are running as fast as they can, but their competitive position isn't actually improving. They are stuck on a treadmill. A biologist investor learns to identify these Red Queen industries and avoid them. They look for businesses like Coca-Cola in 1988, businesses that have achieved a level of dominance where they don't have to run as fast, yet their castle remains secure. This biological perspective gives you a powerful blueprint for analyzing any business, the business ecosystem map. It's a way to visually and conceptually model a company's competitive environment. Step 1. Identify your target species. This is the company you are analyzing. What does it eat? Its revenue sources. How does it defend itself? Its competitive advantages. Step 2. Map the predators and direct competitors. Who are the other species trying to eat the same food? How strong are they? Do they compete on price, a bloody, energy-intensive battle, or on differentiation, carving out separate niches? Step 3. Chart the symbiotic relationships. Who are the company's key suppliers, distributors, and customers? Are these relationships healthy and mutually beneficial, or is one party exploiting the other? A company with a single, powerful supplier or customer is in a precarious position, like an animal that can only eat one type of plant. Diversity creates resilience. Step 4. Scan for invasive species. What are the potential disruptors? Is there a new technology, a change in regulation, or a new business model from a completely different industry that could invade this ecosystem and change all the rules? This is the asteroid that could cause a mass extinction event. Step 5. Define the niche. After mapping the ecosystem, can you clearly articulate the specific niche that your company occupies? How defensible is that niche? Is it a wide, resource-rich territory or a tiny, precarious ledge? This exercise in critical thinking forces you to move beyond simple market share numbers and understand the deep structure of competition. It's an essential tool for any entrepreneur trying to carve out a place in the market, or any investor trying to find a business that can survive and thrive for the long term. The antithesis, the path of the 99%, is the tragic story of Eastman Kodak. For most of the 20th century, Kodak was not just a company, it was an institution. It was one of the most dominant species the corporate world has ever seen. Their niche was chemical photography. Their yellow boxes of film and paper were ubiquitous. Their brand was as powerful as Coke's. Their moat seemed infinitely wide. They were the apex predator of their ecosystem. But their ecosystem was about to be hit by an asteroid: digital technology. The tragic irony is that Kodak was not blindsided. A Kodak engineer named Steven Sasson invented the first digital camera in 1975. But Kodak's immune system, its corporate culture and incentive structures rejected the invention. They were a chemical company. Their entire business model, their very identity, was based on selling film and paper. Digital photography was an invasive species that threatened to eat their food source. Instead of adapting, instead of evolving to become the dominant species in the new digital ecosystem, they tried to protect their old one. They suffered from institutional inertia, the biological equivalent of a species that is too perfectly adapted to one environment and cannot change when that environment shifts. They kept running the film-based race, even as a new, faster race was starting on a different track. Competitors like Sony, Canon, and later the smartphone makers were the new, more adaptable species. They swarmed into the new digital ecosystem. Kodak, the once mighty dinosaur, was driven to bankruptcy and extinction. They failed to understand the biological law that states, adapt or die. The direct financial connection of this biological thinking is one of the most important concepts in all of finance: return on invested capital, or ROIC. A company's moat, its defensible niche in the ecosystem, is what allows it to sustain a high ROIC over long periods. In a truly competitive ecosystem with no moats, competition would drive down the returns for all participants to the cost of capital. It's like a field of grass with many herbivores. They will eat all the grass until there is just enough left for the herd to barely survive. But a company with a strong moat, a powerful brand, a network effect, a regulatory advantage, is like a predator that has exclusive access to a rich hunting ground. It can earn returns far in excess of its cost of capital, year after year. By learning to think like a biologist, you can identify these businesses. You can look at a company like Moody's, the credit rating agency. Its moat is the fact that it is one of only 3 major players, a regulatory oligopoly. Or a company like Google, whose moat is the network effect of its search engine. The more people use it, the better its results become, which attracts more users. These businesses have wide, sustainable moats that allow them to generate massive amounts of cash and produce extraordinary long-term portfolio growth. They are the great, enduring species of the corporate world. The investor who can identify them, who can analyze the ecosystem and not just the spreadsheet, has developed a truly profound and profitable advantage. It is a vital component of a superior investment strategy and the third powerful pillar in your mental lattice work. After layering your understanding with insights from psychology, engineering, and biology, the final and broadest perspective comes from the grand sweep of human history and philosophy. If the other disciplines provide the tools to dissect a company in the present, history provides the context, the long-term perspective that immunizes you from the manias and panics of the moment. It teaches you the one lesson that the market is always trying to make you forget. The things that are happening now have happened before, and they will happen again. Greed, fear, innovation, war, collapse, and rebirth. These are not unique features of our time. They are the recurring patterns of the human story. The anecdote that captures this worldview is Warren Buffett's investment in the Washington Post Company in the early 1970s. The country was in turmoil. The Watergate scandal was unfolding, a constitutional crisis that shook the nation. The stock market was in a deep bear market, crushed by inflation and economic uncertainty. Fear was rampant. The Washington Post's stock had been hammered, falling by nearly 50%. On a spreadsheet, the company looked risky. Newspaper advertising was cyclical, and the industry faced an uncertain future. A narrow-minded analyst would have seen only the immediate problems. But Buffett, an avid student of history, saw something else. He was not just buying a newspaper. He was buying a powerful and enduring American institution. He understood the historical role of a free press in a democracy. He knew that in a world of growing complexity, people would always need trusted sources of information. The Washington Post, especially under the courageous leadership of its publisher Katharine Graham during Watergate, had solidified its position as one of those essential institutions. He also understood the historical pattern of market cycles. He knew that periods of extreme pessimism and fear, like the one in 1973, were almost always the best times to invest. He was able to look past the frightening headlines of the day and see the long-term, durable value of the franchise. He wasn't analyzing the next quarter's earnings. He was analyzing the company's place in the next chapter of American history. He invested around $10 million. That stake would eventually become worth over $1 billion. It was an investment decision born not from a financial model but from a deep understanding of history, power, and human nature. This historical mindset is a powerful antidote to two of the most dangerous psychological biases that afflict investors: hindsight bias and the narrative fallacy. Hindsight bias is the tendency to look back on past events and believe they were predictable and inevitable. We look back at the 2008 financial crisis or the dot-com bust and think, of course that was going to happen. The signs were all there. This makes us overconfident in our ability to predict the future. History, when studied properly, teaches us the opposite. It teaches us about the role of luck, of small events that cascade into massive ones, of contingency and uncertainty. It shows us that the future is not a straight line to be extrapolated, but a messy, unpredictable unfolding of events. The narrative fallacy, a term coined by Nassim Taleb, is our tendency to create simple, coherent stories to explain complex, random realities. We want the world to make sense, so we string together a few facts and create a compelling narrative. The story of a visionary CEO who single-handedly built an empire is much more satisfying than the messier, more truthful story of luck, timing, and the contributions of thousands of people. A historical perspective makes you skeptical of these overly simple stories. It teaches you to look for the deeper, more complex forces at play. This leads to a practical blueprint for lifelong learning that Charlie Munger has advocated for years: the Reading Gibbon framework. Edward Gibbon was the great 18th century historian who wrote The History of the Decline and Fall of the Roman Empire. Munger suggests that by studying the great patterns of history, the rise and fall of civilizations, the great bubbles and manias, the long cycles of war and peace, you can develop a set of mental models for understanding the present. The blueprint is a three-step process of applied history. Step 1. Choose a major historical boom and bust cycle to study in depth. It could be the Dutch tulip mania of the 1630s, the South Sea bubble in Britain in 1720, or the Japanese real estate bubble of the 1980s. Step 2. Dissect the recurring elements. As you study these events, you will see the same patterns emerge again and again. You will see the arrival of a new, exciting technology or financial innovation. You will see a rapid expansion of easy credit that fuels the speculation. You will see a mass psychological phenomenon of euphoria and social proof, where everyone believes they are a genius for participating. You will see a rejection of old valuation metrics and the triumphant cry of, "This time it's different." And finally, you will see the bubble pop, followed by panic, finger-pointing, and financial ruin. Step 3. Use this historical pattern as a mental checklist. When you find yourself in a roaring bull market, you can pull out this checklist. Do you see a new technology being hailed as a world-changing paradigm? Check. Is credit cheap and widely available? Check. Are your neighbors who know nothing about investing suddenly giving you stock tips? Check. Are people scoffing at traditional valuation methods? Double check. This historical pattern recognition doesn't give you a crystal ball to predict the exact top of the market, but it serves as a powerful warning system. It is the voice of history whispering in your ear, "Be careful. I've seen this movie before, and I know how it ends." The antithesis of this worldview, the absolute rejection of historical perspective, was the dot-com bubble of the late 1990s. It was a textbook example of mass delusion, fueled by the narrative that the internet had fundamentally repealed the laws of economics. Young analysts and day traders, with no knowledge of financial history, genuinely believed that profits no longer mattered. All that mattered was eyeballs and growth. Companies with no revenue, no profits, and no viable business plan were being valued at billions of dollars. The mantra, "This time it's different," was everywhere. Anyone who brought up old-fashioned concepts like price-to-earnings ratios was mocked as a dinosaur, unable to grasp the new economy. Warren Buffett and Charlie Munger were those dinosaurs. They were publicly ridiculed for sitting out the bubble, for losing their touch. But they weren't stupid. They were historians. They pulled out their mental checklist of past bubbles, and they saw a perfect match. They knew that while the technology was new and exciting, human nature, the greed, the envy, the herd behavior, was as old as the hills. They chose to endure the short-term pain of underperformance and the public criticism in order to avoid the long-term catastrophe they knew was coming. When the bubble inevitably burst in 2000 to 2002, trillions of dollars of speculative wealth were vaporized. The new economy believers were financially and emotionally devastated. Buffett and Munger, with their capital intact, were able to step in and buy wonderful businesses at bargain prices. Their historical perspective was their shield. The direct financial connection of this historical and philosophical worldview is a deeper understanding of the most powerful force in finance: interest rates. Buffett has said that, quote, "Interest rates are to asset prices what gravity is to the apple. When interest rates, gravity, are very low, asset prices, the apple, can float up to very high valuations. When interest rates rise, gravity reasserts itself, and asset prices fall." By studying financial history, you can understand that we have been in a multi-decade period of falling interest rates, a long period of weak gravity that has levitated the prices of stocks, bonds, and real estate. A historical perspective prepares you for the fact that this is not a permanent state of affairs. Cycles turn. The investor who understands the history of interest rate and inflation cycles has a massive advantage in asset allocation and risk management. They can see how different valuation metrics, like the P/E ratio, expand and contract depending on the prevailing monetary environment. They are not surprised when the tide goes out. This grand perspective, drawn from the deepest wells of human experience, is the final, essential pillar of your mental lattice work. It completes the structure, elevating your decision-making from a mere technical skill to a form of worldly wisdom. It is the ultimate tool for achieving true financial freedom, because it teaches you not just how to make money, but how to think about money, risk, and time in a way that aligns with the enduring realities of the world. You have just spent your time and attention absorbing a framework that is nothing short of a complete operating system for better thinking. This isn't a stock tip or a simple hack. It is the blueprint for the mental architecture used by the world's most successful investors to navigate the complexities of the market and of life. You have moved beyond the flat, one-dimensional world of the spreadsheet and have been given the master key to a multidimensional analysis. You've learned to see a business not as a collection of numbers, but as a human system, an engineered structure, a living species in a competitive ecosystem, and a player on the grand stage of history. This is the foundation of a true CEO mindset, a powerful tool for your personal finance journey and for any executive decision-making you will face. But it is crucial to understand that what you have just built is the first essential pillar of a much larger structure. A lattice work is not a single beam, it's an interconnected web of ideas. Knowing that you need to draw models from psychology, engineering, biology, and history is the foundational insight. But it opens up a new, more advanced set of questions. Which models are the most important? Out of the hundreds of cognitive biases, which are the 5 you must know cold? Out of all the principles of engineering, which 2 or 3 have the most direct application to your portfolio? The challenge shifts from knowing you need a toolkit to mastering the specific tools within it and knowing precisely when to use each one. The model you use to analyze a stable, dominant brand like Coca-Cola is not the same one you deploy to understand a disruptive, high-growth technology company. The lens for evaluating a bank is different from the lens for evaluating a manufacturer. The video that is now appearing on your screen is designed to be the next piece of that map. It is the practical guide to the great models themselves. It takes the theory of the lattice work and forges it into a set of specific, actionable mental tools. It is the critical link that connects the why you have just mastered with the what and how of daily application. It closes the gap between knowing that mental models are important and having a prioritized arsenal of the most powerful models ready to deploy with surgical precision against any problem you face. Most people will stop here, content with the overview, satisfied with the theory, but for those of you who are truly serious about this journey, for those who are committed to the path of lifelong learning and the pursuit of financial freedom, the next step is not an option, it is an obligation. The greatest investors are not just collectors of models, they are masters of them. The choice to click is not about watching another video. It is a decision to continue your ascent, to move from apprentice to craftsman. Complete your mental arsenal, sharpen your tools, click the video and take the next step.